Manage real estate and maintain protection, growth, and leverage underneath the tax-free umbrella. You're going to gain insights on opportunities that you never knew existed. Lock in. My name is Justin Smith, and I've been a retirement specialist and a financial strategist since the turn of the decade. I've had a strong passion of educating people about the risk and tax mitigations. One of my favorite instruments is called the Max Funded Tax Advantage Index Universal Life Policy, or what I like to call the Smith Fund, saving money in tax-free homes, if it's properly structured and funded correctly. This vehicle can be a dream solution for many things. In this episode, we're going to talk about how many real estate investors manage their real estate, use it as a working capital account, and also learn how to get out of debt quicker, make it smarter decisions, and make money faster. Let's talk about a few insights of how you can actually do this. So if you didn't know this already, the Max Funded Index Universal Life Policy, if structured correctly, what you're doing is you're taking the smallest amount of insurance possible that the IRS will allow you to get away with and funding it with the most money possible that the IRS will allow you to get away with underneath 3 tax citations. That is 7702, 72E, and 101A. Also, the 3 codes, the 3 tax codes, which is TEFRA, DEFRA, and TAMRA. There are plenty of other episodes on this channel that teaches you about these citations. Matter of fact, go ahead and subscribe to this channel so we can get this information out to people on a weekly basis. Tune in. Now, in an IUL, when it's structured properly, you're doing it so you can grow your money tax-free, you can access your money tax-free, and when you die, it'll blossom and transfer to your heirs tax-free. This is provided underneath the 3 section codes in the Internal Revenue Code for over 100 years. These codes are 72E, 7702, and 101A, and they're all over this channel. Now, the citations, the tax citations are TAMRA, TEFRA, and DEFRA, and those are all acronyms. So like I said, the goal is to put the most money in that the IRS allows us to, while also tackling the smallest amount of insurance that the IRS allows us to turn this thing into a cash cow, tax-free. Many real estate investors use this as working capital. Since 1997, when the IUL actually came out, the average return rate was anywhere between 7 and 10%. Rule 72 says that if you were to divide your annual rate of return by 72, your money would double. Meaning, if you had an annual rate of return of 10%, your money would double every 7.2 years. How about that? So many real estate investors, as they manage that, they will take their rental income and instead of paying down their mortgage, they're savvy and they're smart. So the mortgage might be 4.5% tax deductible, meaning in a 33% tax bracket, they will only be netting 3. So on $1 million mortgage, they're paying $30,000 in interest. And in the IUL policy, they're earning 9 after gaining 10% gross. How much is 9% more than 3%? It's 3 times more. So they're earning $90,000 on that million and they're paying the mortgage company 30% or $30,000. This is how the banks operate. They pay interest when you put money in the bank or the credit union. They pay you nothing more than 1% and they turn around and put that money into insurance companies which pay them 4 to 5%. What real estate investors do is they realize that if I'm using OPM like the banks do, and I have a mortgage or mortgages on my portfolio, I'm paying a net 3%. Then I keep my money over here in the IUL, gaining 9%, where it's got protection, leverage, and growth, not to mention the liquidity. So I'm making 3 times more interest on my working capital. So instead of paying down the mortgage and then they get into trouble, we have a recession, they have vaccines, they have to then refinance or sell or borrow even more money. Let's say you're a real estate investor and you do want to get out of debt. You just want to sleep at night because they're all paid off. I will prove to you mathematically how you can do this with the IUL policy. Also, at the end of this video, I will gift you a free ebook that shows you A to Z of how to properly structure and fund your IUL or Smith Fund policy. That is, if you want to get out of debt and your definition of debt is not owing a dime to anybody. If you send extra principal payments against your mortgage to the mortgage company, you're giving up your liquidity. You're also giving up the protection of your principal because real estate can drop at any moment. That also means you're giving up your liquidity and your growth. And rather than that, I suggest you put your money into an IUL policy, let that money compound, and when the time comes, you'll be able to take a sum or a lump sum of money out of that policy and be able to pay off your mortgage 2 to 3 years faster, sooner than giving your money to the mortgage company. Now, a lot of people believe that they can pay higher interest or higher principal and get out of debt in 15 years. But is that really true? If you took that difference of the 15-year mortgage payment and the 30-year amortized mortgage payment and put it away systematically into a Smith fund or an IUL policy, you will have enough money in a lump sum to be able to pay off your mortgage 2 years faster. And this is by using Uncle Sam's money rather than your own money. Now, you may be thinking, whoa, hold up now. But honestly, if it took the same amount of time, I'd still do the IUL policy because you'll have access to liquid capital. Honestly, it's a lot easier to get it out of an insurance company rather than having to try to get it out of a mortgage company or even a bank. Because at that point, I would have to actually prove why I need that money. It's like when I need it the worst, it's the hardest to get. That don't make sense. Here's another reason why real estate investors should consider the IUL policy. Many real estate investors will take that positive cash flow from their investments and put it into an IUL policy just in case something pops up, like a multifamily complex. Let's say you need $1 million for earnest money. Within 72 hours, you can have that money in that property, tied up in that property that was gonna cost you millions of dollars. All you would need to do is call me up and say, hey, Justin, I need $1 million out of my policy. At that point, I will send you the form, have you put your name on it and your policy number, which is like your account number, and you would choose to borrow the money out of your policy. Now, you could withdraw the money with no problem, but I suggest you choose to borrow it because of the principal arbitrage. Let's say you borrow $1 million and they charge you 5% interest on the policy. The insurance company will continue to credit you at the index rate, which many times continues to double. I hope you caught what I just said. You borrow the $1 million and they charge you 5%. Now, you could have borrowed that $1 million and they could have charged you 2% and they could have also credited you 2%, which is called a zero wash loan. That's usually the more conservative route to take. But let's just say you understand how money works. So let's just say the insurance company charges you that 5%, but you also make sure they continue to credit you on that $1 million that's in that policy. This means that the insurance company is loaning you money but using your $1 million as collateral within the policy, as if it's still in the policy. For example, let's say that $1 million earns 25%. This means $250K minus $50K, meaning you netted $200,000. Tax-free. This is on that $1 million that you were using as earnest money just for that fix and flip apartment complex. This is done all the time. Honestly, most of the time, a portfolio of IULs will outperform that real estate portfolio when it comes to tax-free access and protection. This is without having to chase tenants, fix toilets, or even pay property managers. But that's a discussion for another time. There are just so many options or opportunities when it comes to either trying to get out of debt, or maybe you just want to keep the property and use that cash liquid for working capital. Maybe you just want to sell it. Where do you put that money? You put that money into an IUL policy that accumulates more tax advantages, and when you die, that money blossoms and also transfers income tax-free to your family. Now, if this is something that popped a light bulb in your head, first thing I want to ask you to do is please subscribe to this channel. And secondly, click the link in the description. There's a free ebook, the Smith Fund ebook, that shows you A to Z of how to properly structure and fund your Smith Fund or your max funded tax advantage IUL policy. My name is Justin Smith, and we'll see you next episode. Peace.